Okay, welcome to day 5 of week 1. We've covered a lot of material. I've certainly been a little bit more long-winded than I wanted to be. So yesterday's shorter lecture, today's shorter lecture is in some ways a reflection of my belief in my relative long-windedness. So let's not keep that up. So we end the week, I think, in a really good place in terms of setting us up for next week. So today, what we'll do is we'll place money into the context of the neoclassical model. That's one of the big, I would say, issues with the classical model, and to some extent, the sort of neoclassical view is that it does not have a way very much to incorporate prices, other than to say that we tend to think about prices as really only affecting the real wage in the classical model, right? If you go back to the lectures on Thursday, yesterday's lectures in terms of the classical model, the sort of linchpin of the economy is the production function. And then the production function generates this sort of labor demand. And then this labor demand in conjunction with the production function generates this real wage. And that's really the only place that prices show up. And so in a sense that's sort of reflective of the kind of classical view that money in a sense is not the real economy, that the real economy is the actual goods and services, the consumption and production of those actual goods and services, to the extent that we even have this concept called monetary neutrality, which basically says that you really only need to look at the real values to understand an economy. So both the classical and neoclassical views take on this concept. It's called the classical dichotomy very often. And it basically says we can essentially ignore nominal concepts and only therefore think about real values, which allows us to effectively ignore prices. The problem with this is, in some sense, obvious, but then the kind of broader problem with it is that even prior to the sort of Keynesian revolution, there was a clear, I think, articulation that prices mattered and the price level mattered, and that prices, beyond the fact that they generated this sort of nominal GDP that was a function of real GDP, but was not real in a traditional sense, that you needed some sort of way to incorporate what was obvious at the time, because at the turn of the 20th century, you have a proliferation of banks, you have a proliferation of lending institutions, you have the stock market, of course, becoming a very much larger part of the economy. And so it was no longer the case that economists could sort of ignore that monetary side of the economy and then really started to finally incorporate it into the neoclassical model. So that's really kind of going to be the major thing that we do today. So we bring with us that kind of neoclassical model, and then we're going to put into it now basically a concept of money. And then this is going to motivate a conversation that we're going to have ultimately about inflation, and then really inflation expectations, which sets up some really interesting conversations that we'll have later in the semester. So, what is money? Economists have a very, in a sense, strict definition of what represents money. It needs to be three things: medium of account, store of value, and a unit of account, rather, excuse me, and medium of exchange. If something does not do all of these three things, then economists don't tend to refer to it as money. Now, obviously, at times there are assets such as Bitcoin or other sort of currency-like things that sort of maybe can behave like money or have money-like characteristics. But for something to sort of be considered money, it really needs all three of these particular characteristics. And then a broad conversation, and I think, again, this sort of underlies why we need to start putting money into the model, is that we're going to kind of think about money in a macroeconomy really as referring to liquidity. So the extent to which there is cash available to be spent in an economic system, that's going to be a big part of policy. It's going to be a big part of how we think the underlying macroeconomy actually works. If you look at the slides, there's actually a link here to an article by the St. Louis Fred, basically, asking the question, is Bitcoin money? And there's some really interesting analysis there. So it's not just someone who doesn't like Bitcoin, and therefore it's, I think, a really interesting look at whether an economist would consider Bitcoin to be money. Now, from a macroeconomic perspective, the most important thing about money is sort of the idea that it's used in the furtherance of transactions. So when we think about the usefulness of something like currency, there's a real efficiency gain to currency. And certainly if that currency is then broadly accepted, not just in your country. We haven't really talked about open economy stuff, but it sort of goes without saying that there's a lot of benefit to other countries also utilizing your particular currency. And obviously the US benefits massively from being what is effectively the global currency as the US dollar. But at the end of the day, the most important sort of part of what sort of money represents is that it is a part of the supply and demand of the economic system. It's, in a sense, it's the way in which sort of supply and demand works ultimately. And so therefore conversations about money and then inflation in particular are going to loom very large. Now, we could sort of think more generally about central banking policy or banks in general, or we can certainly put this into the context of the Federal Reserve. I like to sort of do both at the same time because it helps us to sort of, again, start to feed into that realism of the model. I would say one thing that happens is that economic models become a little bit more realistic over time. The classical model, as I'm sure you no doubt have noticed, is full of a bunch of very rigid, hard to believe assumptions. The neoclassical sort of does some things with some of those assumptions, but leaves a lot of the hard to believe ones alone. And then sort of as we develop economics moving forward, we start to chip away a little bit at some of those particular weaknesses. And we do so in particular ways within countries. So, prior to the early 1900s, the U.S. financial services industry is marked by extreme levels of dysfunction. There were constant runs on banks, you had constant banking collapses. It was not a healthy system. And so it did not necessarily contribute very much to the macroeconomy, especially during instances where it was dysfunctional. So sort of one of the ideas behind central banking is that you want your lending institutions, you want your banking institutions to work in favor of your economy, to work in a way that benefits your economy. And so having a central bank to sort of help to manage things like a money supply, which ultimately ends up being a liquidity management tool. Having a central bank, which perhaps like we in the US, regulates banking and sets rules and standards and so on and so forth. And then more probably important than anything else is that a central bank is going to represent that lender of last resort that's in a sense going to prevent bank runs, bank collapses, and hopefully prevent the sort of domino falling effect that we saw, especially in the United States in the 1800s. There's just a tremendous amount of tumultuous banking activity. So the establishment of the central bank in the US, the Federal Reserve, sort of coincides, I would say, broadly with a general improvement in the belief of the usefulness of a central bank. Obviously, in the US, the idea of a central bank was very politically controversial. So it wasn't something that people necessarily wanted at first. But I think if you look back at the relative stability that the establishment of the Federal Reserve has had on the US economy, it's fairly, I think, obvious that it's been a net positive. It doesn't mean that the Federal Reserve has always done a good job. In fact, that'll be a thing that we talk about quite a bit this term is failures of institutions such as the Federal Reserve. But I mean, the idea here is that the central bank was a response, the Federal Reserve was a response to the fact that the sort of financial services side of the economy was becoming more and more important, was becoming a more powerful part of the broader macroeconomy, but that it was very unstable. And so therefore its contribution to the broader macroeconomy, its contribution in terms of just general prosperity was somewhat limited. So we established the central bank in the United States. One of the main things that the central bank does is it manages what we refer to as the money supply. We're going to have a very general definition of the money supply here in a moment. This is obviously a very specific version of money supply in the US. So M1 just sort of represents the most liquid assets, so cash, checking deposits. And then historically, we did not include savings accounts into M1. But as you notice, they are right at 2020. There seems to be this just great increase in the M1 money supply. That's actually because we redefined M1 to also start including savings accounts. Basically, the idea here is that M1 represents the most liquid assets. M2 represents M1 plus some additional less liquid assets. So M2 has like CDs, it has money market accounts. Basically, what happened is that over time, savings accounts just became more liquid. Right, like I have a couple savings accounts. It takes me 2 seconds if I want to move money from one savings account into my checking account or between. It doesn't take any time at all. Previously, it took a long time to move money from a savings account into a checking account or to get that cash. And so the redefinition of M1 to include savings accounts was a reflection in many ways of the technology that has allowed greater liquidity. And that's, I think, a part of the general story here is that some of these ideas of sort of the general money supply concepts were generated and created at a time when the technology just did not offer as much of a liquidity sort of idea as we have today. That's, again, a very good thing. Historically, one of the main problems in the financial services industry ends up being a lack of liquidity, either because of a credit crunch or because of some sort of exogenous shock. So if you look at money supply over the sort of post-COVID time in the United States, we can see that there was this general increase in the money supply. And then as we get towards 2023, you see that the money supply starts to come back down somewhat. Whenever you see the money supply go up, that's generally due to expansionary monetary policy. In the case of the COVID experience, the Federal Reserve dropped the target interest rate to basically zero for about a year or a year and a half. And then about, we'll see here, June 2021, we start to see that money supply sort of continue to increase, go up. And then around 2022, we start now targeting higher interest rates in the US. And as we start targeting higher interest rates, the money supply declines. And so I think the simplest way here to sort of think about monetary policy is to first think about it in terms of the money supply, and then just remember that expansionary monetary policy means the money supply goes up, and contractionary monetary policy means the money supply goes down. And in a moment, we'll tie that back to interest rate policy in just a moment. So you can see here, during COVID, during the immediate couple of years after COVID, we had pretty sizable growth in M1 money supply. And then once the Fed started targeting higher interest rates as a means to try to fight the inflation that we saw in 2022 and 2023, we see the growth rate of the money supply decline as we would expect. Now, again, tying this idea of sort of central bank policy or central bank sort of where it fits into the neoclassical model, but coinciding with the reality of the U.S. Federal Reserve. So when we think about the U.S. Federal Reserve sort of monetary policy suite, what they have access to, we traditionally refer to there being three policy tools: open market operations, discount rate, federal funds rate targeting, and reserve requirements. Open market operations is just buying and selling of government bonds. If the central bank wants to increase the money supply, they're going to buy bonds from the market. So they take bonds off the market and they put cash on the market. If the Federal Reserve wants to reduce the money supply, they're going to sell bonds. They're going to take bonds and put them in the market and take cash out of the market. And so open market operations is just, again, you want to increase the money supply, you're going to buy government bonds. You want to decrease the money supply, you're going to sell government bonds. Discount rate, federal funds rate. This has become the main policy tool of the sort of modern Federal Reserve. We have sort of been interest rate targeting for a long time now, but it actually is, we interest rate target by, in a sense, manipulating the money supply. So when we say that the Federal Reserve is targeting, when we say the central bank is targeting a higher or lower interest rate, what we mean is that there is an interest rate that the central bank controls, and then theoretically and empirically, we know that interest rates, all the other interest rates in the economy, are going to be based upon that rate. And that rate we refer to as the discount rate. So the discount rate is the interest rate that banks pay to the Federal Reserve for loans they take out in what we refer to as the overnight window. So there is this overnight window in which banks who need cash, perhaps to cover loan payments or maybe to cover losses, can go to the Federal Reserve. They can take out a loan and they pay a discount rate. So when the Fed wants to encourage taking out loans, they reduce the discount rate. The effect is that it increases the money supply. If the Fed wants to discourage this, then they're going to increase the discount rate, and this has the effect of reducing the money supply. The federal funds rate is an interest rate that is based on the discount rate, and it's the rate that banks pay to each other. And so the discount rate goes up, federal funds rate goes up, and then banks don't want to lend money to each other as much. And so again, you get a real sort of simplicity here in terms of thinking about expansionary monetary or expansion or contractionary monetary policy. So with respect to discount, with respect to interest rates, if the Fed targets higher interest rates, that's contractionary monetary policy. And if they target lower interest rates, that is expansionary monetary policy. Reserve requirements used to be a bigger issue. So the Fed has certain reserve requirements for banks. They have to keep a certain amount of their deposits in the form of cash on reserves. The greater those requirements, the smaller the money supply, because the greater those requirements, the less loans the commercial banks will be making. But we don't use the reserve requirement as much anymore. Historically, banks have kept more than the reserve requirement, so it doesn't really make sense as a policy tool. It's nothing there to kind of manipulate. There are a bunch of other sort of monetary policy tools. If you follow this link to the Federal Reserve website, you'll see a bunch there. One of the big ones nowadays that's sort of a non-traditional form of monetary policy is currency buying. So one of the things the Fed does is they also pay attention to the exchange rate. And so they will buy or sell foreign currencies as a way to keep their balance sheets healthy, but also to sort of move the exchange rate around if they so choose. But we're going to keep things simple from now. So we're basically just going to think in terms of expansionary monetary, expansionary or contractionary monetary policy. Here's the behavior of the discount rate over time. You see that during recessionary periods, the discount rate gets dropped because the Fed is trying to boost the money supply to in a sense, keep the economy going. That is a sort of non-classical idea in many ways. So when we start talking about the Federal Reserve or a central bank, targeting higher or lower interest rates as a means to boost the economy or maybe even slow down the economy if there's inflationary fears, that is a very non-classical and in some sense a non-neoclassical idea. The classical model didn't really have money in it, and so this idea of the Fed targeting higher or lower interest rates or putting more or less money in terms of the money supply just did not really sort of show up. And so this idea of the Federal Reserve targeting higher and lower interest rates would be sort of anathema in many ways to the classical and some of the neoclassical economists. So again, this is why we need to sort of embed the idea of money into this. Here's the discount rate window relatively recently. You can see post the Great Recession as well as post COVID that those interest rates go down to almost zero, because again, we wanted to encourage liquidity. We wanted more liquidity out there than what the market was naturally producing because the market was declining. And as the market declines, liquidity starts to dry up. And so the Federal Reserve, the central bank, will step in and try to maintain liquidity and inject liquidity into the economy. Again, that is somewhat of a modern view. And when I say modern, I mean kind of post-World War II view of the macroeconomy. Here's just federal funds rates over time. And we'll talk more about these when we get to next week. Okay, so now to sort of contextualize the sort of conversation of the Federal Reserve with sort of, again, a model of the money supply. This allows us, again, to kind of have conversations that, even though the neoclassical model doesn't necessarily do a great job of saying a whole lot about inflation, that's going to be one of the things that we really get to next week and beyond. It does allow us to sort of understand the effect of the money supply on the economy more broadly. It allows us to understand the effect of, for example, increases in checking deposit withdrawals, increases in loans, and what those ends up having an effect on in the economic system. Okay, so we're going to develop a very simple model of a money supply. We're going to start with the idea that your money supply M here is equal to what we refer to as currency and then deposits. So currency is cash on hand, deposits is cash that has been put into a bank. And then we also are going to model this idea of a monetary base. Monetary base is currencies plus reserve. So you think about the difference between deposits and reserves. Reserves is deposits that the bank is not loaning out. So it's money that has been put into the bank, and the bank is keeping that money and not sort of loaning it out. So that explains a little bit of the difference between deposits and reserve. The idea in an economic system is that the central bank ultimately controls, or I guess a good way to think about it would be manipulates the monetary base. So the sort of central idea, the central theory of monetary economics is that the central bank of an economy is able to control and or manipulate the monetary base of that economy. And the way that they do this is they manipulate it through influence on currency and influence on reserves. Okay, so the sort of policy tools of a central bank are to manipulate what is essentially the monetary base. And then what we're going to see is that in manipulation of the monetary base, this enables the central bank to ultimately manipulate the money supply. Okay, so the math here it looks a little gnarly, but it's pretty straightforward, just some simple algebra here. So what we're going to do is we're going to take that money supply and we're going to divide it by the monetary base. We're going to end up referring to this M over B here in a sense as the sort of idea of money balances. And then we'll see why we do that in just a moment. So M divided by B, and then all we do is we take that currency plus deposits, right? Because M was equal to currency plus deposits. And then we divide that by B, and then we remember that B was equal to currency plus reserve. And so what we have is M divided by B is equal to C plus D over C plus R. And then what we're going to do is we're going to put all of our currencies, deposits, and reserves into what we call deposit ratios. So we're going to do currency to deposit ratios, deposit to deposit ratio, which is just one, and then reserve to deposit ratios, right? So C divided by D, C divided by D here, and then R divided by D. So currency deposit ratio divided plus one divided by currency deposit ratio plus reserve to deposit ratio. And then we're just going to simplify these, and we're going to turn, CR represents the currency deposit ratio, and RR represents the reserve to deposit ratio. And so what this says is that the money supply of an economy is equal to the currency deposit ratio plus one divided by the currency deposit ratio plus the reserve to deposit ratio, and then times that monetary base. So what this means is that the Federal Reserve affects the monetary base, and then in context of the money multiplier. So this is what we're going to refer to as the money multiplier. What this means is essentially when the Federal Reserve or central bank increases the monetary base by $1, to what extent does that actually increase the money supply? Okay, because the increase in the monetary base is going to correspond to a multiplicative increase in the money supply. And that's going to be governed ultimately by this money multiplier. Now, just take a moment to look at the money multiplier. And what you'll see here is that we have some preferences going on, right? So go back to that conversation about consumer preferences, right? The extent to which people want to hold money as currency as opposed to sticking money into a bank, that's obviously going to affect currency deposit ratio. So that affects the extent to which the Federal Reserve is able to increase or decrease liquidity in the macro economy, right? People's willingness to hold cash versus willingness to put money into the bank affects the central bank's ability to manipulate the money supply. And one of the things that we sort of real quick can kind of just say, which I think adds some nice reality here, is that this money multiplier is going to tend to decline during bad economic time periods. Why is that? Because during bad economic time periods, people typically start saving more money. And so they typically start increasing the extent to which they have money in the form of deposits. And so that you can see what the effect that would have here. In addition, during bad economic time periods, we tend to see reserves go up because banks are worried about the future and they want to make sure they have money on hand, cash on hand to deal with anything that may come down the way. And so during bad economic time periods, this money multiplier is going to go down. So the Fed may not be able to increase the money supply as much as they want to during bad economic time periods. And then, of course, during good economic time periods, the money multiplier will tend to be very large. Except during good economic time periods, usually what you're trying to do is maybe even decrease the money supply because maybe you're worried about inflation and all of that very stuff. So, but anyway, a very simple kind of basic model of the money supply. And the idea is that the central bank affects the monetary base. And then this in conjunction with the money multiplier ends up affecting the actual money supply. And there'll be some simple numerical examples here just to kind of work you through those. And it's very easy, right? Just plug and chug kind of various things. But you can see, what happens to the ability of the central bank's ability to increase the money supply via monetary-based manipulation. It's going to be affected by the money multiplier, but at the end of the day, the way the central bank affects the money supply is by increasing or decreasing the monetary base. All right. So issues that are impacting monetary policy, as I just mentioned, is that the central bank is going to manipulate the money supply primarily. Going to manipulate monetary policy primarily through the money supply. And the second thing is that the central bank manipulates the money supply via changes to the monetary base. As we mentioned before, the central bank does have the ability to also manipulate the reserve to deposit ratio via reserve requirements. But for the most part, we just think about, certainly with respect to the Federal Reserve, it's mostly about that monetary base sort of idea. In reality, if we want to sort of think about things in terms of like what this sort of actually is that the money supply is at all times a targeted amount. So in other words, there will be a certain amount of the money supply that the Fed wants to have, and then they will undertake monetary base manipulation to achieve that desired level of the money supply. And that typically involves a large combination of different policies, from open market operations to discount rate, federal fund rate manipulation, to reserve requirements, to all those other things that the Federal Reserve does nowadays to manipulate the money supply. And then one particular issue that's going to come up quite a bit a little bit later is that we historically have thought that monetary policy has at least a year lag in terms of you institute a policy and then it actually fully works its effect out through the macroeconomy. This used to be larger, by the way. We used to think it was upwards of 18 months. And so much like it's easier to inject liquidity into economy, it seems to be the case that monetary policy is becoming, in a sense, more efficient over time as the technology of currency and everything has been improving.